Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and those 10-year note yields. Still holding the range, that 280 to 290 range we've set going back to June 25th. We had the minutes today. They didn't really give us anything to trade off of. Yes, we're trading towards the lower end of that range, but we have yet to really make an aggressive move through 280. So right now still holding in that range. The new trend, I guess, 280 to 290. And the market seems very sort of content to stay here at this moment, despite the fact that we had some numbers, despite the fact that we have non-farm payroll tomorrow. The market doesn't seem very jittery and is sitting in that 280 to 290 range. And if you look at market volatility, it's lower. It saw a modest uptick ahead of the minutes and ahead of the holiday yesterday. But I think that ultimately volatility is going to continue to trickle lower as we stay in this range. Why not? It's holding the trend, staying between 280, 290. Market volatility remains a little bit heavy, and we do have the non-farm payroll number tomorrow. That could change things if we see a breakout move. I think a lot of participants are hoping for a stronger number to see the market rally, maybe see some increase in those wages and take us above 290 yield. That's a big move, especially even on a payroll day. But I think that ultimately the market is going to continue to hold that range or push towards lower yields. And then there are the FOMC minutes we had. What did we learn today? Well, I think there was expectations that we would learn a lot about what happens with growth, inflations, kind of the what if with trade. And we did. We learned a little bit about everything. Yes, the Fed's going to keep an eye on what's happening with trade as kind of their top line concern. Likewise, they're watching what's happening in Europe. And I think that ultimately the talk of the yield curve is maybe the one surprise. They didn't really talk back or try and talk back what's happened with the yield curve. You know, the 2s, 10s dip below 30, obviously the first time since we'll call it August of 2007. And so I think ultimately right now the yield curve is massively flattened, but has continued to do so even since the June FOMC rate hike. So what is the Fed going to do? The market is clearly telling the Fed, or clearly telling everybody that's reading it, that something's wrong. Something with whether it's Fed policy, whether it's expectations, whether it's growth. There is something wrong because the yield curve doesn't continue to get flatter when things are good. So I think ultimately right now the Fed is going to watch that, but they're not going to try and tell you that it's wrong and that they're going to stop or they're going to continue to do, or they're going to stop what they're doing. They are going to continue to gradually raise rates as fit. Certainly as the inflation and growth numbers come in, we obviously won't know that September is the next expected rate hike, and after that it's sort of up in the air whether they're going to go in December, because obviously I think that the September hike is the key one here. Will they go in September based on what we know now? And the market's telling you yes, but the market's still 50-50 about a fourth rate hike later. So ultimately the minutes didn't tell us a whole lot other than the fact that they are watching the yield curve. There is a concern, but they're not going to tell you the market's wrong, which I think is something that in the past they've done. You know, the market has incorrectly priced Fed expectations or policy. They're not doing that under this new chair. So that is probably the one little surprise we take away from this. The Fed will keep watching. Market volatility continues to trend lower. The 10-year yields are stuck in a range. We have non-farm payroll tomorrow. That could change everything. This is Todd Colvin coming to you from the floor of the CME Group.